And into the summer, we've had a nice little rise. Look at this right here. This goes against the grain typically.
Welcome to Gold Silver Pros.
Hey everybody, this is Rob Keens with GoldSilverPros.com. It is this week's weekly market wrap up. It is July 21st, 2023, about 4:30 p.m. Central Time. You guys will be seeing this either Friday, Saturday, Sunday, depending on where you're viewing it. We're going to get into it really quickly. U.S. economic calendar was mixed for the week. And that has to do with the fact that the economy is kind of up and down and schizophrenic just a little bit. And that's normal before you get into a recession. As you're heading into a recession, manufacturing is down. Empire State Manufacturing Survey for the New York area is down to a 1.1. It was a 6.6 last week. It's positive. It's above zero, but it's decelerating or not growing as much. The Philadelphia Fed manufacturing survey is down negative 13.5. That's about the same as last month, a little bit more pessimistic than what economists thought. But that's 11 straight months where Philadelphia Fed manufacturing survey has been down. So manufacturing overall in the U.S. is slowing down definitively. Looking at other data, U.S. retail sales, 0.2% of a gain, a little bit less than last time. Capacity utilization fell down to 78.9. Business inventories rose is 0.2. It means we're making stuff, but not necessarily selling them. A little bit of early channel stuffing, although not enough to really kill the economy. Overall, looks like industrial production down 0.5%. So overall production not doing well. Anything having to do with the productive area of the economy, not service, but manufacturing is basically down. Housing starts and building permits are both down. Housing starts down at 1.43 million. It was 1.56 last month. Building permits at 1.44 million, down from 1.5. So housing is not doing terribly great. Initial jobless claims still elevated at 228,000. So it looks like people aren't quite getting the jobs that maybe we had expected to recover by now. And I don't think that they're going to be honest with you. In other news, as we look at the markets, the bond markets are still in yield curve inversion between the 2 and the 10-year. We've been reporting that for months and months and months. It almost guarantees that there is going to be a recession. And not only that, but the yield curve is now in the deepest inversion since 1981, according to an article from Ryan McMakin at the Mises Institute. He says, Mark Thornton and I both mentioned the yield curve's inversion as an alarming indicator of significant recession in the not too distant future, the article says. Mark Thornton is somebody that he did a podcast with. Thornton mentioned that the most recent inversion of the yield curve is no small or minor inversion, but it's an inversion deep into negative territory. This, Thornton notes, gives us a good reason to expect a serious economic event, whether a recession or even a full-blown economic crisis. How big is big when it comes to the latest inversion? To measure the magnitude of the inversion, still reading from the article, a time series of the gap between the yields and long short term is calculated. If we graph the difference in the 10 and 3 month, we can see that we are now experiencing the largest inversion in more than 40 years. That's right. The yield curves are the largest inverted in more than 40 years. What that means is bond investors expect more yield now than they do in the future. That's opposite because we think we know more about what's going to happen in the near future than the long term. Typically, there could be more risk factors. So when your bonds are expecting more yield in the short term, it means they think the problem's worse now than it's going to be in the future. In other words, they're calling basically for a recession. On to other news. China's digital yuan nears 250 billion transaction volume, according to the central bank governor. Nearly 250 billion worth of transactions have taken place using China's digital yuan in a 1.5 years since the start of its pilot. The country's central bank governor has claimed on July 19th, People's Bank of China Governor Yi Gang told a conference in Singapore that its central bank digital currency transacted 1.8 trillion yuan as of the end of June. Yi added there have been around 950 million transactions from roughly 120 million wallets since the digital yuan's initial January 2022 rollout. So it looks like the CBDC is starting to get a little traction now. 250 billion is not a lot when you look at the size of the Chinese economy, how many people are there, the spend that they usually have, and over the time frame, it's been over a year. But it's significant that it's held 250 billion worth of transactions because they were the first to the CBDC. And if they can get it going at all, that means the rest of the world will also. In other words, this is the beta test for the rollout of the worldwide CBDC to come before too long. In other news, Pfizer plant damage in tornado could worsen nationwide drug shortage crisis. This is the second time I have mentioned the potential for a nationwide drug crisis in the last month. Also, both have relating to Pfizer, either a damaged plant or slowdown in production or a lack of available supplies to make the drugs. A tornado, it says, according to the article, caused extensive damage at a large Pfizer pharmaceutical plant in North Carolina on Wednesday, threatening critical supplies of medicines nationwide at a time of worsening drug shortages. On Thursday, Food and Drug Administration Commissioner Dr. Robert Califf tweeted that the FDA is aware of the storm damage at Pfizer's North Carolina plant and its grateful employees there are unharmed. It goes on to say, I spoke with Pfizer's CEO this morning to understand the extent of the damage and any potential impact to the drug supply and to offer our support. We're following the situation closely, Califf said. Not much is known in the public domain if the destruction of Pfizer's Rocky Mountain plant, one of the largest sterile injectable facilities in the world, with more than 1.4 million square feet of manufacturing space on 250 acres, will disrupt the medical supply chains. In other news, U.S. corporate debt defaults in 2023 surpassed last year's total, according to Moody's. The total amount of corporate debt defaults in the United States this year have already exceeded the amount seen in all of 2022, says Brian Jung via the Epoch Times. Experts have been warning of a wave of defaults to hit the economy for some time due to higher borrowing rates. At least 55 American-based companies defaulted on their loans in the first half of 2023, according to data from Moody's Investor Services. That is a 53% increase from the total number of defaults last year, with just 36 companies said that they would fail to repay their debt obligations to lenders. Moody's blamed higher borrowing costs and tight lending standards for added pressure on companies reliant on credit. In May alone, there were 16 corporate debt defaults worldwide, up from 12 in April. In other news, 80 million Americans to face 105-degree heat this weekend, according to the National Weather Service. This is going to put a strain on the grid. This is in particular interest to me because I live in Texas and we've had grid problems the last 2 years. ERCOT and the state regulators and other state agencies have been working to solve those issues, and we'll see if they're able to do so. The last couple of years during the summer, we have had rolling brownouts in my area in North Texas. I'm expecting some of the same this year as well. So we basically put everything on battery protection and just expect to live in a little bit warmer environment when those brownouts roll through. We'll see if that happens again this year. According to the Epoch Times, the National Weather Service is warning about more scorching heat across the United States in the coming days, with about 80 million Americans set to experience 100-degree plus temperatures this weekend. An extremely dangerous and record-breaking long heat wave will continue over the Southwest well into next week, the NWS said in a July 20 post on Twitter. Now getting to gold. Gold is down $10.44 today to 1961.85 at the time of this reading, which is probably going to be about where it ends up on the day since we're at Friday afternoon. Silver is down 19 cents to 24.61, but they've had a very nice rally. They're doing better than they were 30 days ago. So I'm actually pretty happy about that. Let's go ahead and get into the gold and silver analysis. The technical analysis here, you can see a COMEX gold chart on screen. Let me get this a little bit bigger for you guys. And what I wanted to show you on a one-year chart is that gold has been a nice trend up for the year. We're doing pretty well. In fact, since January, we've had a nice little rise. And into the summer, we've had a nice little rise. Look at this right here. This goes against the grain typically. This is the normal fade. From May down to June, we had a bit of a fade, and then boom, we're re-challenging where we were in May. Now, we're not quite up to where we were in May, but we've had a nice little rebound early. This is a little baby summer swoon, and it's not enough to think that both gold and silver aren't going to be doing well in the fall. In fact, this nice little ramp up in gold, given the two technical indicators, the RSI and the MACD on a short-term chart, indicates that we expect the gold chart or gold to be bullish moving into the fall. Same with silver. Silver's done really well. It's almost recovered to where it was in April and in May. It had a little bit bigger swoon early because silver tends to be a little bit more volatile. It'll move more, so it moved more down and actually came back up more than gold, where gold is nice and smooth. Silver is choppy, but silver is following gold and having a nice little rally here midsummer, earlier, probably a month or two than I would have expected. It's bumped up against the upper limit of the RSI index and the MACD, which indicates it could be in an overbought position from a technical perspective. However, these indexes are basically rolling and reset every day. So I expect that silver and gold could continue to rise. Although if we had a little bit of a fade at the end of this week today, like we have, and next week, it would not surprise me. Moving on to the ETF funds, one of the things I'd like to point out that net on the COMEX, we've added 5,429 gold ounces. Overall, we've subtracted between the UK and the US markets over 1 million ounces, in the last 4 weeks. In particular, GLD, the biggest of the ETFs of passive funds, has lost 487,000 ounces. So people are taking gold off of the index, although COMEX added a little. We added a little in America, but a lot came out of London, a lot came out of the UK. You're going to see the same thing in silver. An absolute ton came out of SLV. Sales in the last 4 weeks of 16.5 million ounces as investors liquidate. Of course, over on the COMEX, we've had it added. So what that tells me is gold is flowing from east to west, from the UK to the US. You can clearly see it in the flows. Will we have a shortage condition in silver? I reported on that last night on our channel on Gold Silver Pros. I think we could be setting up for one, because just look at the total amount of silver ounces held. It has fallen and it's not rising back up at all. And I think that that could be bearish for silver overall. And in London and then Chinese market, pretty much holding serve in gold and silver, nothing to report there. But overall, it looks like a little bit of strength early in the middle of the summer in gold and silver, and that's positive moving forward. The economic fundamentals are choppy to some. Housing starts are not doing well. Manufacturing is collapsing or slowing down, depending on what part of the country you look at. The fundamentals in the economy are not great. Consumers are using more credit and credit defaults are going up. So it looks like the end of any sort of consumer-led recovery. And I think when we get back from the summer into the fall, we'll know more about this economy as people start making their investments and making their decisions. We do know that a lot of money's been pulled out of the banking system. We'll see if the banks are solvent enough to hold up. In the recent stress tests of the banks, they did okay. And as I was looking at corporate earnings for the banks in the second quarter, they actually did okay. Now, a lot of banks are making a little money. Some banks are making a lot of money, but the banking sector overall was somewhat healthy in terms of revenues. Not a smash up quarter at all, but at least holding serve. And so I think in the very near term, I don't expect a lot of banks to go out of business. However, liquidity ratios across the board for banks, not only in the US, but across the world, are low. So even though they made a little bit of profit, it doesn't really put a dent into the amount of debt that they held, and especially the liabilities on their balance sheet. So if we have a run in one of the markets, even though the banks are okay with existing liquidity ratios, it won't be enough to stop their slide and eventual failure or more. We'll pay attention to that the rest of the summer and into the fall. Thank you so much for joining the program. This is going to be a short weekly market wrap because it's summer and there's not as much going on, but we did cover the news that you need to know and the data that you need to know. Hopefully you guys have a good weekend and stay tuned to this channel as we come back next week and we'll give you more news and information. This has been Rob King, your host with GoldSilverPros.com weekly market wrap up.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.